If you sell a car for $14,000 in cash, and you decide to deposit $7,000 today, and the other $7,000 next week just so your bank doesn't report you to the government, you just committed a federal felony. It's called structuring, and last year alone, the federal government seized funds from thousands of ordinary, innocent Americans who thought they were just being smart with their own money. Something just changed. In the last 24 months, without a single news alert, without a single senator giving a speech about it, the rules around moving your own money have been rewritten, and every single rewrite makes it harder, more dangerous, and more expensive for the ordinary American. Most people are playing a game with their money, but they don't know the rules. They think the IRS is out to punish them for being successful. They think the bank is there to protect them. They are wrong on both counts. Today I am going to show you exactly how ordinary people are accidentally triggering federal investigations and having their accounts frozen. And then I am going to flip the script. I am going to show you how the wealthy use the exact same system, the exact same rulebook to legally pay 0% in taxes. In the next 20 minutes, we are going to cover the $10,000 bank trap, the 5 protection moves you need to make this week, the hidden tax menu the government desperately wants you to use, and the invisible bills that seniors and the middle class are paying right now that they are legally exempt from. Stop being a passive observer. Stop playing defense with your money. Let's look at the rulebook. Let's start with the rule that is quietly catching millions of Americans, the $10,000 bank trap. Under the Bank Secrecy Act of 1970, every financial institution in the United States is required by law to file a currency transaction report, a CTR, anytime a customer makes a cash transaction over $10,000. That report goes directly to the Financial Crimes Enforcement Network, not the IRS, a completely different bureau. To understand why this is a crisis today, you have to understand the number. The $10,000 threshold was written into law in 1970. In 1970, a gallon of gas was 36 cents. $10,000 in cash could buy you 2 brand new Cadillacs. If Congress had indexed that number for inflation, the reporting threshold today would be over $81,000. Instead, the threshold has been frozen in amber for over half a century. Today, a normal retiree doing normal things, a kitchen remodel, buying a used car, getting an insurance payout, routinely crosses $10,000 multiple times a year. In 1970, this rule caught drug traffickers. Today, it catches your grandmother. But the report itself is not the problem. It's routine paperwork. Your reaction to the report is where people destroy themselves. When most people hear about the $10,000 rule, their instinct is to stay under the radar. They think, I'll just deposit $9,000 instead, or I'll break it up, a little here, a little there. Do not do this. Under federal law, breaking up your own clean, legally earned money to avoid a reporting threshold is a crime called structuring. You do not need to be laundering money. If the money is clean, legally earned, legally inherited, and you deliberately break it into smaller amounts, you have committed a federal offense, punishable by up to 5 years in prison and forfeiture of the money. Banks now use highly advanced pattern recognition algorithms. If you deposit $9,000 on Monday and $8,000 on Wednesday, the system doesn't see 2 ordinary deposits, it sees a pattern. The system flags you and files a suspicious activity report (SR). And by federal law, the bank is prohibited from telling you they filed it. You could be flagged right now and have absolutely no idea. But the government isn't just watching cash anymore. Change number 3 in the new rules brings Zelle, Venmo, and Cash App into the exact same reporting pipeline. For tax year 2025 and 2026, the reporting threshold on these digital payments is scheduled to drop to just $600. When your church sends you $600 to reimburse a funeral reception, or your neighbor Venmos you $700 for a kayak you sold them, it triggers a Form 1099-K. They are treating your digital wallet with the same scrutiny as a suitcase full of cash at the border. But what if you aren't depositing money? What if you want to take your own money out? Let me tell you the story of Martin and Carol. Martin is 71, a retired regional manager. Carol is 68, a retired nurse. They live in Arizona. Last October, they decided to buy Carol a new car in cash to avoid financing charges. Martin drove to his bank to withdraw $40,600. He handed the teller the slip. A few minutes later, the branch manager pulled Martin into a private office and began interrogating him. "Why do you need the cash? Did someone on the internet tell you to withdraw this?" Martin, a perfectly competent man with no cognitive issues, was treated like a victim. The manager told him the withdrawal would be delayed by 72 hours. Why? Because of a new rule rolled out to protect seniors from elder financial exploitation. Banks now have the legal authority and total legal immunity to freeze senior accounts for up to 72 hours. If their algorithm detects a suspicious withdrawal. But to an algorithm, suspicious just means different from your normal routine. If you usually withdraw $300 a week and today you want $40,000 for a car, the software flags you. The bank freezes your money and they don't even have to tell you why. So how do you protect yourself from the structuring trap and the 72-hour freeze? You put a defense protocol in place. First, stop trying to manage the reports. If you sell a car for $14,000, deposit the full $14,000 in one transaction. Bring a copy of the bill of sale. A routine report gets filed, you have your proof, and your life continues. Paperwork is your shield. Second, pre-notify your bank before you make a withdrawal or transfer over $8,000. Call your branch manager. Explain what the transaction is for and ask them to note it in your customer file. When the transaction hits the compliance software, the note is there and the 72-hour freeze almost never happens. Third, use wires for large purchases. The Bank Secrecy Act thresholds were built around physical cash. If you are buying a car, wire the money directly to the dealer. And finally, ask your bank about a senior safe banking authorization. This is a formal written agreement you put on file that pre-authorizes large everyday retirement transactions like home improvements or buying a car. It clears you through the fraud algorithm before you even walk in the door. Now that you know how to stop the government from seizing your money by mistake, let's talk about how the government literally hands you money. Most Americans look at taxes the wrong way. They think they are being punished for being successful. They are not. They are paying taxes because they have not yet learned how the system was built. The tax code is not designed to be fair. It is designed to incentivize behavior. It is a menu. Every single line item in the tax code was written by Congress to steer private money toward something the government wants built. Housing, energy, business investment, retirement. If you do what the tax code wants you to do, they subsidize your life. If you ignore the menu, work a W-2 job, and collect a paycheck, you pay the highest effective tax rate in the country, between 25% and 37%. Meanwhile, the average wealthy American pays closer to 15%, not because they have better accountants, but because they ordered off the right side of the menu. Here are the items they are ordering that you can start using today. Menu Item 1, Start a business. The moment you have a legitimate business, every economic relationship in your life changes. Your laptop, your cell phone, the miles you drive, the meals you eat, meeting prospects, it all becomes deductible. Under Section 179 of the tax code, you can write off up to $1 million of business equipment. A regular employee making $100,000 pays taxes on $100,000. A business owner making the same amount can legally deduct tens of thousands of dollars in expenses before the IRS ever sees a penny. Menu Item 2, the Augusta Rule. This is Section 280 of the tax code, and it is beautiful. This rule says you can rent your personal residence to anyone, including your own business, for up to 14 days per year and collect the rent completely tax-free. If you hold quarterly board meetings at your home, you can pay yourself $2,000 a day in rent from your business. You claim a $28,000 business deduction, and you personally collect that $28,000 tax-free, zero tax. Menu Item 3, Hiring your children. Under current rules, children under 18 working in a parent-owned business do not have to pay payroll taxes. And if their total wages stay under the standard deduction, they pay zero federal income tax. You get to take income from your 37% tax bracket, drop it into their 0% tax bracket, take a full business deduction, and transfer wealth to the next generation. A family with 2 kids can legally move $30,000 a year off the parent's tax return this way. Menu Item 4, Real Estate and Phantom Losses. This is where the wealthy quietly build generational money. When you buy a rental property, the IRS lets you deduct something called depreciation. They assume the physical building slowly wears out over 27.5 years. So if you buy a $500,000 rental property, the IRS lets you deduct roughly $14,500 from your taxable income every single year. But here is the part that blows people's minds. The property isn't actually losing value, it's probably going up. You are collecting rent, building equity, the property is appreciating, and the IRS is cutting your tax bill based on a fictional loss that isn't really happening. It is a phantom loss. Combine that with a 1031 exchange, where you roll the profits of one house into a bigger house to defer capital gains forever. If you are over the age of 65, or if you have parents who are, this next section is critical. There are at least 5 bills the average senior is paying right now that they are legally exempt from. Nobody is going to call you to tell you to stop paying them. The system is built so the money stays where it is unless you stand up and claim it. Bill number 1, Federal Income Tax and the Senior Bonus. Starting with the 2025 tax year, there is a new rule hidden inside the tax code called the Senior Bonus Deduction. Every single person 65 or older gets an extra deduction of up to $6,000. If you are married, that is $12,000. This stacks on top of your standard deduction. For a lower-income senior on Social Security, this pushes your federal tax liability to absolute zero. For a middle-class retiree making $90,000 a year, this is real money back in your pocket. Bill number 2, Property Taxes. Comfortable retirees always assume they make too much money to get property tax relief. They think it's only for low-income seniors. But many states have an age-based freeze with no income test at all. In states like Texas, once you turn 65, you get a tax ceiling that freezes your school property taxes for life. But here is the catch. Your county will not apply this automatically. Every dollar you claim is a dollar of revenue they lose. You have to actively call your county assessor and ask to file for the senior exemption. Bill number 3, the Medicare IRMAA Surcharge. This is a trap aimed right at the comfortable retiree. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge they pile on top of your Medicare Part B and Part D premiums if you have a high income. But here is the trick. Medicare bases this surcharge on your tax return from 2 years ago. Picture this. You are 64, working a high-paying job. You retire at 65 and your income falls off a cliff. But Medicare looks at that old tax return and hits you with massive surcharges for money you are no longer earning. People just pay it because they assume the government is right. They aren't. There is a form called the ESSA 44. If you have had a life-changing event and retirement is legally on that list, you file this form, prove your income dropped, and they recalculate your premium. That one form can put thousands of dollars a year back in your pocket. And finally, the ultimate bonus move, the 0% capital gains bracket. When your taxable income is low enough, your federal tax rate on long-term capital gains is not 15%, it's not 20%, it is 0%. In 2025, a married couple can have taxable income up to roughly $96,700 and pay 0% on long-term gains. Retirees are in the perfect spot to use this. In those years right after you retire, but before your required minimum distributions kick in, your income is often at its lowest. A smart retiree harvests their stock gains in those low-income years on purpose, pulling wealth out of the market completely tax-free. Let me show you what happens when you actually learn the rules and stop playing defense. I want to walk you through an example that will change how you think about money forever. Imagine a business owner making $250,000 a year. Without tax planning, they are handing $80,000 to $90,000 to the government every single year. Over 30% of their life's work gone. Now imagine that same person using the rulebook I just gave you. They open a solo $401,000 and contribute $69000 that comes right off their taxable income. They put $8,000 into a health savings account, the only account in America with a triple tax advantage. Money goes in tax-free, grows tax-free, and comes out tax-free. They buy a $300,000 rental property and do a cost segregation study. To front-load $30,000 of depreciation in year one. They pay their two teenage children $12,000 each for actual work in the business, moving $24,000 into a zero tax bracket. They use the Augusta rule to rent their own home to their business, collecting $28,000 tax-free. Add up the deductions. That person just legally erased around $240,000 of taxable income. Their effective tax rate drops from the mid-30s down to the single digits. They just put $70,000 back in their own pocket in a single year. And that is just year one. Imagine stacking those strategies year after year. The rental properties grow, the retirement accounts compound, the kids grow up with real Roth IRA accounts in their own names. 10 years from now, that person has millions of dollars in additional net worth compared to the version of themselves that did nothing and just paid the standard bill. That is not hypothetical. The rental properties grow, the retirement accounts compound, the kids grow up with real Roth IRA accounts in their own names. 10 years from now, that person has millions of dollars in additional net worth compared to the version of themselves that did nothing and just paid the standard bill. That is not hypothetical. That is the math. The people who build real generational wealth learn early on that money is not earned the way most people think it is. It is not earned just by working harder. It is earned by positioning yourself inside the parts of the tax code that Congress subsidizes. The IRS is not an enforcement agency. It is an incentive program dressed up as an enforcement agency. The sooner you see that, the sooner you stop being a tax victim and start being a tax beneficiary. If you are holding cash, do not structure it. If you own a business, read the menu. And if you are over 65, stop overpaying your invisible bills. Do me a favor, knowing these rules is not enough, you have to act on them. Send this video right now to one person in your life who is over 60, or a friend who owns a business. It does not matter if they are getting by on a single check or sitting on a paid-off house. One share from you could save them from a frozen bank account, or save them thousands in taxes they never had to pay. Hit the like button so the algorithm shows this to more people who need to hear it. Subscribe to the channel, make the decision to take control of your money today, and I will see you in the next one.